Welcome back, Navigators. In today's video, we'll discover strategies to build solid stock portfolios so we can further optimize investment returns while minimizing risk. Picture this: a quaint coffee shop, the aroma of freshly brewed coffee filling the air. Sarah, a young woman with a dream of early retirement, sits at a corner table, her eyes glued to her laptop screen, not scrolling through social media but reviewing her stock portfolio. It's her roadmap to financial freedom, a concept that once seemed impossible but is now within reach. Sarah wasn't born with a silver spoon. She worked hard, saved diligently, and then discovered the power of investing. Now she's on track to achieve her dreams, all thanks to a well-constructed stock portfolio. We all have dreams, aspirations that might seem out of reach, but just like Sarah, we can take control of our financial future. So Navigators, grab your favorite beverage, get comfortable, and let's embark on this journey to financial empowerment together. Let's be honest, the term stock portfolio can sound intimidating. It conjures images of Wall Street tycoons in power suits, barking orders and making millions. But the truth is, a stock portfolio is simply a collection of investments, a bit like a basket of different fruits. Think of it this way: you wouldn't put all your eggs in one basket, would you? The same principle applies to investing. A diversified stock portfolio spreads your risk across different companies, industries, and asset classes, protecting you from potential losses. Imagine owning shares in a technology company, a healthcare provider, and a consumer goods giant. If one sector takes a hit, the others can cushion the blow, ensuring your portfolio remains stable. It's about making smart, informed decisions that align with your financial goals and risk tolerance. And the best part? You don't need to be a financial whiz to get started. Now that we've demystified the concept, let's get down to the brass tacks: building your very own stock portfolio. The first step is determining your financial goals. Are you investing for the short term, 1-3 years, medium term, 3-7 years, or long term, 7+ years? This will influence your risk tolerance and asset allocation. So are you saving for retirement, a down payment on a house, your dream vacation, or maybe your child's education? Once you know your destination, you can chart the best course. Next, consider your risk tolerance. Are you comfortable with market fluctuations, or do you prefer a more conservative approach? This will influence your asset allocation. Now comes the exciting part: choosing your investments. This is where research is key. Look for companies with a solid track record, strong financials, and a competitive edge in their respective industries. Consider having exposure to cyclical sectors, for example, energy, industrials, as well as defensive sectors, for example, utilities, consumer staples, to balance the portfolio during different economic cycles. If you have strong convictions about certain trends, for example, renewable energy, AI, or cybersecurity, incorporate some thematic exposure while ensuring the overall portfolio remains diversified. Focus on companies with strong earnings growth, high return on equity (ROE), and solid balance sheets. Look at financial metrics like PE ratio, debt to equity ratio, and gross margins. Also, it pays to look for stocks breaking out of consolidation patterns or crossing key moving averages, 20, 50, or 200 DMA with high volume. Consider setting stop loss levels to limit downside risk, but give winning positions room to grow. Avoid holding on to stocks with deteriorating fundamentals or persistent underperformance. Review your portfolio's performance at least quarterly to evaluate the performance of individual stocks and the overall portfolio. Then rebalance your assets and stay informed about economic data and market trends to ensure you're on track to reach your financial goals. Just like any journey, the path to investment success is not without its potholes. One common mistake is emotional trading, letting fear or greed dictate your decisions. Remember, the market is driven by sentiment, and it's easy to get swept up in the hype. Another pitfall is poor diversification, putting all your eggs in one basket. This can be disastrous if that one investment sours. Timing the market, trying to predict its ups and downs, is another trap to avoid. Even seasoned professionals struggle to do this consistently. Instead, focus on time in the market, allowing your investments to grow over the long term. Stick to reputable financial institutions and advisors, and always do your research before making any investment decisions. Let's bring this to life with some real-world examples. Remember the dot-com bubble of the late 1990s? Many investors caught up in the frenzy poured their life savings into tech stocks only to see their portfolios decimated when the bubble burst. On the flip side, those who stayed the course during the 2008 financial crisis, riding out the volatility and continuing to invest, were rewarded with significant gains as the market recovered. The lesson? Don't panic during market downturns. Stay focused on your long-term goals and remember that time is your ally in the market. By avoiding emotional decisions and staying disciplined, you can weather the storms and come out ahead. Investing is no different. You've made it this far, so let's turn knowledge into action. Here's a roadmap for creating your winning stock portfolio. First, define your goals. What are you saving for? Retirement? A down payment? Knowing your destination helps you chart the course. Next, assess your risk tolerance. Are you comfortable with market fluctuations, or do you prefer a more conservative approach? This will guide your asset allocation. Then choose your investments. Research companies, diversify across sectors, and consider using low-cost index funds or ETFs for broad market exposure. Monitor and adjust. To give you an idea of how a sound, balanced and diversified portfolio may look like, consider investing 40% of the funds in large-cap stocks, for example S&P 500 companies, 20% in mid-cap and small-cap stocks with higher growth potential, 20% in international stocks to give you some global exposure, a 10% chunk in REITs or real estate stocks, diversification through property, while 10% may be kept in cash or bonds for stability and liquidity. These practices aim to create a robust portfolio that balances growth potential with risk management, offering a structured approach to navigating the stock market. Regularly review your portfolio's performance, rebalance your assets, and stay informed about market trends. By following these steps, you can create a solid foundation for financial success. So, take charge of your financial future today and start building your path to financial freedom, one stock at a time. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.